Hello, everyone. Good evening, and welcome to today's session. This is the Hack the Gold 2026 guide. My name is Ambrose Ebuka. First of all, welcome to the session, guys. Thank you all for joining today's session. Today, we're going to be discussing something really interesting, something that captured the attention of a lot of traders around the world this year, and also the massive price movements in the gold market between January and February 2026. But before I dive into today's session and before I, get into the discussion, guys, let me know in the comments your name and where you're watching me from today. Go ahead and let me know in the comments your name and where you're watching me from today. Welcome to the session. And while you guys do that, I'm just going to run through this disclaimer and we get started. Any opinion, news, research, prices, analysis, or other information discussed in this webinar or linked to this presentation is provided as general market commentary and does not constitute investment advice. Let's see who we have in the chat today. Hello, Manisha. Hello, Mazha from India. Guys, if I don't pronounce your name correctly, apologies in advance. Sai Sanjay, welcome to the session. Guys, this session is specifically designed for all level traders, especially beginner traders as well. So if you're new to trading or you're still trying to understand, how financial markets behave, you're absolutely in the right place. Today, we're going to go through everything step by step. I'm going to use simple explanations that are very much simple to follow. I won't use any complicated terms or any confusing concepts. It's just going to be practical insights that you can actually understand and apply to your trading journey. Now, for those of you that don't know who I am, my name is Ambrose Ebuka. I have 6 years of trading experience developing profitable swing and scalp trading strategies. I also have an 85% accuracy in chart analysis for gold, which is the subject of discussion today, GBP JPY and GBP USD. And I also conduct rigorous backtesting to consistently validate and optimize trading effectiveness. Let's see who we have in the chat. Manisha from India, welcome to the session. Welcome to the session, guys. So in this session, we're going to focus on 4 key areas. First, we're going to break down what actually happened in the gold market earlier this year. Have the key takeaways. I would also break that down for you guys as well. Secondly, we'll discuss why a lot of traders, ended up in drawdowns during that time. And we'd also look at, how, in terms of lesson learned, how traders could have approached the market differently in that moment. Can you guys hear me? All right. All right. It's good. And we'd also have one or two active intraday strategy, which is obviously how traders could have approached the situation differently, how you could have taken advantage of the move, some strategies, including the one that I use, which is the zone trading strategy as well. And we'd also explore other markets that you can trade besides gold. So we'll look at 6 alternative assets with lower volatility that you can trade besides gold. And we'll have a Q&A session, guys. In this Q&A session, you get to ask me questions, and I will also ask you questions as well. So very important that you pay attention to this session. Now, for those of you that are already here, guys, at the end of this session, there will be a promo code that gives you a 100% bonus on your deposit. So do well to stay to the end to take advantage of that promo code for a 100% bonus on your deposit. This session is going to last for 45 minutes. I'm constantly looking at the live chat to see if you guys have any questions or any comments. So you can go ahead and use the YouTube live chat to ask your questions. I'll be checking them periodically to answer your questions. Now, before we continue, before we go straight into today's session, I want to ask you guys a quick question, right? How many of you here have traded gold before? Even if it was just once, you traded gold. Let me know in the chat. How many of you have traded gold before? Gold is one of the most widely traded assets in the world, especially among retail traders as well. It's also one of the most volatile markets. And what I mean by that is the prices of gold can move very quickly within a short period of time. And that's exactly, what we witnessed earlier this year. So let me know in the chat, guys, if you've traded gold at least once this year. Let me know in the chat. Let's see. Let's look at the chart. Okay. Mazhab said, I have. Israel Okuruk says, I have. P.E. Apple says, I did this week. Tumi from South Africa, welcome. Ken from Owerri, welcome. I'm seeing you guys joining. Owen from Lagos, welcome. Okay, that's Owen said, I traded gold this week. Kendrick said, yes, I trade gold. That's the only pair that I trade. Now, before we go deeper into the market movements, let's first talk about what gold actually is in the trading world, right? Most people know gold as a precious metal. It's something, it's even stored by central banks, but in the financial markets, gold has another very important role. Gold is considered a store of value, and that simply means people use gold to protect their wealth, especially during times of, economic uncertainty. For example, if investors are worried about things like inflation, economic instability, geopolitical tensions, currency weakness, a lot of them will move their money into gold. And that's why you see in articles, you see in videos, you see online that gold is called a safe haven asset. A safe haven asset is something that investors buy when they want stability, when they want protection during uncertain times. Now in this market, and I'm just doing this for those of you that don't know what gold is or how it's traded in the market, right? So in the Forex market, right, most traders are not actually buying gold bars, like the gold bars you see in movies. And if you've seen gold bars in real life, we're not buying gold bars in the market, right? We're trading gold digitally through financial markets. Now, in trading platforms, gold is shown as XAU USD. You'd see this a lot in the market. XAU, let me just extend this a bit. XAU USD, right? Now, XAU is the international symbol for gold, and USD represents the dollar. So when you see XAU USD, it means the price of gold measured in US dollars, and that's what you're seeing here, $5,139.40 per ounce of gold. So if gold is trading at, let's say, $5,200, it means that 1 unit of gold is worth $5,200 US. And when traders buy gold, they expect the price to increase. When traders sell gold, they expect the price to decrease. Let me know in the chat if you guys understand that before we get straight into what happened this year. Let me know in the chat if you understand what I just explained. Gold can be a very profitable market, but it's also very fast and very volatile. All right. So as traders, you must approach gold with discipline, proper risk management, and patience. And this is exactly why understanding what happened between January and February 2026 is very important, because it kind of tells you how powerful and sometimes dangerous the gold market can be when you eventually choose to venture into gold trading. And for those of you that are already trading gold, Kendrick said it's been so unpredictable this week. Gold doesn't respect. Guys, let me know in the chat if you guys can hear me. Okay, I think we're good. Okay. All right. All right, guys. Okay, you can hear me. Everybody can hear me. Perfect. So I was just saying that gold can be a very profitable market, but it's also very fast and very volatile. I'm happy that you guys can hear me. The connection keeps glitching. I don't know why, but I think it's good now and everybody can hear me. So we're going to get straight into what happened. Well, we'll start from November. I was going to focus on January up until now, but then it's very important that I take you guys back from the initial pump and the reason why gold is currently where it is right now. So we're going to start with a very simple timeline, right? So we have November, the move in November, we have the all-time high in January, we have the pullback, or should I say the correction, the crash in February, and then the recovery that's currently happening with gold right now. So we're going to take it step by step, and I'll explain it for you guys so everybody can understand. Now, if we go back to November 2025, gold was trading. Let's go to the live chart, guys. Let's go to the live chart. Let's go to the 4-hour time frame. I think we should change this to the daily time frame. Okay. All right, so everybody can see the move to the top side. All right, guys, so let's start from November around here. Can extend it all the way up. Now, around November, guys, gold was, okay, this is 2025, rather. Gold has been moving up since forever, guys. Let's go to 2025. start from here. Yep. So let's just start from here, right? Now, if you use the crosshair, guys, look at the right-hand side. You see every single time you put your crosshair tool on the chart, it tells you the price at that time, right? So here you're seeing gold was trading around 4,000 to, like, let's say $4,200 per ounce. And you can see that at this time, the market was already showing signs of a bullish move to the upside. Give me a second, guys. This is this one. Right? You can see that at this time, the market was already showing strong upward trend. You can see the high was created, and then you see the market make all these bullish moves that tells you this high is being tested and it's going to be potentially broken. This gives you an idea that the buyers were in control and the price kept trying to move higher. And what happens? Over the next couple of weeks, over the next couple of months, the demand for gold increased significantly. A lot of investors were buying gold as a safe haven asset. They were using it as, remember I told you guys, safe haven asset means they were using it as protection against economic uncertainty. Now, this buying pressure continued pushing the price of gold to the upside. And then what happened? January, I'm going to put this here. Let's say January 29th. Keep it right up here. January 29th, gold reached something that we call ATH, and ATH is an all-time high. Now, an all-time high is simply the highest price an asset has ever reached in its history. An all-time high is basically the highest, price that an asset has ever reached in its history, and gold approximately touched $5,608 in January 29th. Now, when markets, go up and reach all-time highs, something interesting usually happens. A lot of traders start to feel what we call FOMO, right? The fear of missing out. They see the market going up, they see the market pumping up, and they start to think, oh, I need to enter before it goes even higher. I need to join at the top. I need to buy now. And they start buying aggressively. But here's something I want you guys to understand, especially beginner traders. When the market rises too quickly, there is something called overbought or overheating. If you look at the RSI here, let me give you guys an illustration of that. If you look at the RSI here, you clearly see that when there was all these spikes to the upside, the market was clearly overbought. And what happens when the market is overbought is there is usually a correction. Now, if you see January 29th, you can see it here. What happened? Literally a few days later, the market dropped from around 5,600 all the way down to about 4,400. I think I should also indicate that as well. All the way down to about 4,400. That's about 21% decline in just a few days. Let me also give you guys the... We're going to take it out from here, put it on the charts. You guys can see, right? Let's take it all the way up. 21% decline. Let's just say 21 point, let's just say 21%, right? 21% decline, you can see it here, minus 21% in just a few days. Moves like this can be extremely dangerous for traders that use high leverage, especially if you're not using stop loss. Because if you're buying here, all your stop losses would have been liquidated. But the story did not end here. What happened right after? After getting to this bottom at 4,400, buyers returned to the market, and in a couple of days and extending to a couple of weeks, what happened? Gold recovered all the way back to 5,200 and even higher to make a potential retest over here. So we had 21% decline and then an 18% recovery to the upside, right? So let's do this like this. Since it's a recovery, we'll keep it this way. So 18% recovery to the upside. Now, within a short period of time, just a couple of days, the market has rallied to the, should I say a couple of months rather, the market has rallied to the upside. There was an all-time high created, there was a crash, and then there was a powerful recovery. Now that brings me to a very important question, and I want you guys to let me know in the chat. Why did so many traders get into a lot of drawdowns in this period? Let me know in the chat. Why did so many traders get into a lot of drawdowns? If you have an idea why, let me know in the chat. Why did so many traders get into a lot of drawdowns during this period? Let me know in the chat, guys. Guys, I haven't been checking the charts, but let me check the chart right now to see if you guys have any questions. Okay. No questions. So let me know in the chat, guys. Why did a lot of traders get into a lot of drawdowns? Why did a lot of traders get liquidated, get stopped out during this period? If you know the answer to that, let me know in the chat. Guys, remember, while you're commenting, there is slow mode. It's turned on, so you can only comment after 1 minute from your last comment. And if you're joining this session or you want to take part in the conversation, you can click the subscribe button, because you can only comment if you're subscribed to the channel. So do well to go ahead and subscribe to the YouTube channel so you can be able to comment and take part in the conversation. All right. All right. Now, when we analyze what happened during this period, we're going to see three major mistakes that a lot of traders made, especially beginner traders. And understanding these mistakes is very important if you want to improve as a trader. The first one is lack of stop losses, or using stop losses that were too wide. Now, if you don't know what a stop loss is a predefined level where your trade automatically closes if the market moves against you. You can call it a safety net. But unfortunately, a lot of traders don't use a stop loss at all, or they place their stop loss too wide. So when the crash happened, their losses became much larger than expected. But professional traders understand one thing: protecting capital is more important than chasing profits. And I want you guys to keep that at the back of your mind. The second mistake was aggressive position size and trading too large, over leveraging. A lot of traders were opening positions that were simply too large for their account size. When the market moved against them, even slightly, their accounts suffered a lot of drawdowns. If the market is volatile, it's good to reduce your risk. Maybe 1% of your account in a single trade, especially when the market is volatile, right? I'm not saying that 1% is what you should use for the rest of your trading career. I mean, if you decide to do that based on your account size as well, it's good. But when the market is volatile, it's very important that you reduce risk. Now, I saw someone say something in the chat about how gold doesn't respect technical analysis, and it's always focused on geopolitical tensions and this and that. That brings me to the number 3 mistake. Guys, I'm looking at the feedback of the stream right now, and it's glitching a bit. I have no idea why that's happening, but I mean, if you guys cannot hear me at any point, let me know in the chat. If you guys cannot hear me, or the stream stops at some point, just let me know in the chat, guys, and I'll work on that. It's glitching a bit. I have no idea why that's happening. But we're going to get back into the session. I'll keep going as long as you guys can hear me. The third one, it brings me to the third one, the comment I saw in the chat, in the live chat, ignoring macro triggers. Now, or should I say ignoring the bigger picture. Markets are not influenced by only technical charts, especially the gold market. We have economic news, we have geopolitical developments, we have central bank decisions. All these things influence price movements. During this period, there were several macroeconomic triggers that increased volatility in the gold market. And if you continue to ignore all these factors, you'll be caught off guard in this market. Let me know in the chat if you guys are following. Let me know in the chat if you guys are understanding everything I'm saying. Because when I don't see questions, I assume that the session is pretty comprehensive and you guys understand everything. So let me know in the chat if you guys. I asked the question before, and I told you guys to tell me why you think a lot of traders were in drawdown. So I'm going to be reading out your comments right now. Mohammed says because of volatility. Israel says due to lack of the use of SL in the trade when at the overbought zone. That's a good one. P Apple, I'm trying to remember his name. Owen, yes. He said because they thought gold will explode during the geopolitical conflict, they over-leveraged. Good one. Mark says because the war between the US and Iran, so there was tension in the market. Israel says, okay, we can hear perfectly. Amazing, amazing. I mean, the conflict still links to geopolitical conflict as well. Okay, everyone understands. Perfect, perfect, perfect. Good answers, guys. Good answers. Now, how did profitable traders act? Because while a lot of traders were buying at the top, preparing for a possible reversal. Now, if you look at 28, just right here. In fact, let me make it a zone for you guys. Let me make it a zone for you guys, right? All right. Gold had already been rising strongly in this zone for days. Gold was already trading above overbought level for weeks. When the market rises very quickly without it can become what we call overbought. Overbought simply means the price has moved up too fast and may be due for a correction. Now, one of the tools that we use to measure this is called the RSI, the Relative Strength Index. The RSI measures momentum. It tells you how strong the buying pressure or the selling pressure is. And if you look at the RSI, you see that we have 70 at the top and we have 30. At 70, it means the market is considered overbought. At 30, it means the market is considered oversold. Now, during this rally, you see that the market moved all the way up to 91. That's an extremely high level. For experienced traders, that's a signal that momentum has gotten to exhaustion point. It doesn't mean the market will crash immediately, but it tells you the market is very much overbought, very much overheated. Be very careful when chasing buys. Let me know if you guys are following. Let me know if you guys are following. So instead of chasing the rally and chasing buys at overbought levels, professional traders and experienced traders started looking for opportunities to sell or to short. Shorting means selling the market in anticipation of a price drop. And you would obviously see that with this rejection here and then the follow-up on the bearish candlesticks. Now, if I'm to be honest with you guys, because of the kind of strategy that I use, which is the zone trading strategy, I would have not sold at the top. I would have waited for the next candlestick or the next day to open bearish, and that's when I would have started to look for sell opportunities. The idea of developing an edge in this market is so that you don't randomly enter. You wait for confirmations, exhaustion candlesticks, rejection at resistance or support levels, divergence confirmation, so that when the price starts to drop to the downside, you can go ahead and take your trades. And then you have some, and you can see that all this, if you had entered this trade, all the positions would have come out very profitable, about 800 pips, which is obviously a very profitable trade. Another thing that professional traders, they didn't necessarily just sell the market, but they did something very important. They closed their buy positions early when, you know, the news started increasing volatility. Remember, if you want to be a professional trader, you don't have to always try to catch every single move and every single candlestick. Sometimes the smartest decision is to simply protect your profits and step aside. So when this gold market became very unstable and choppy and wild, many traders took out their profits on the long and buy positions, wait for clear opportunities. And that way, they avoided this crash that followed. And it gave you, if you were actually one of the traders that took out profit here and avoided this crash, it should have given you more opportunities to enter for another buy at the low. Now, the key takeaway I want you guys to understand is the goal is not to predict the exact top or the exact movement. The goal is to recognize when the market is becoming overbought and manage your risk accordingly. Pay attention to indicators, momentum on the charts, price action, news events. These things would help you decide if you should enter the market, if you should stay out of the market. You know, it just gives you an idea on what to do. The most important lesson I want you guys to understand from this: risk management. Risk management is more important direction, guys. If you forget everything else from this webinar, I want you to remember this one thing. Trading is not always about predicting the market. It's about managing risk. It's not about being right all the time. It's about, you know, protecting your capital even when you're wrong. A lot of beginner traders believe success in trading means you have to predict every move correctly. But professional traders understand something that's very different. Even the best traders in the world can make drawdowns and losses. But what makes them profitable is not perfection. It's risk management. Let me give you guys an illustration right now. Let me give you guys just a simple illustration. Something. Okay. So during the, let's use capitals. During the January-February gold move, right, the market dropped about 21% in just a few days. Now, imagine two traders. We have trader A and we have trader trader B, right? Let's bring it down a bit. Now, trader A entered the market without a stop loss, right? So let's say no stop loss. Trader B had a clear risk rule, right? So when the market crashed, trader A was hoping, oh, this market is going to reverse, it's going to go up, it's going to go up. But the price kept falling. You guys can see it here. The price kept falling all the way to the downside. He entered, no stop loss. His money was getting into crazy drawdowns and he was hoping. And his drawdowns became larger and larger until his account was severely damaged, right? Trader B, on the other hand, had a clear risk rule. So before entering the trade, he decided if the market moves against me, I will only risk 1, 2, 3% of my account. So when the market dropped, his stop loss was triggered. And he lost a maximum of 3%. He closed the trade and he moved on. Now, he still had 97% of his capital left. And when new opportunities appear, he can trade again. The difference between these two traders was not intelligence. It was discipline. Trader A was focused on being right and, you know, hoping. Hope is not a strategy. Trader B was focused on staying in the business. And in trading, staying in the business is everything. Because there will always be another opportunity tomorrow. But you can only take advantage of that opportunity if your capital survives today. Let me know in the chat if you guys got that. Guys, the market does not reward traders that gamble. The market rewards traders that protect their capital and stay consistent. So the real question that you should be asking yourself before entering a trade is not how much am I going to make, how much can I make? The real question is how much am I risking if the market goes against me? And that simple question can completely change the way you trade. Let me know in the chat if you guys understand. Let me see if you guys have some questions in the chat. Understandable. All right. Now, I want everybody to pay attention to this section because understanding what the market looks like today is important, right? It's as important as understanding what happened in the past. The markets are always changing. The environment, the trading environment in 2026 is very different from what we saw in 2024 and 2025. So what you need to understand is that gold, generally as a volatile pair, is even much volatile right now. Volatility has increased significantly. And if you don't know what volatility means how fast and how far prices moves between a short period of time. Gold can move $80 to $120 in a single day. And if you're a beginner trader, it's important because these large price movements can mean large profits for you, but also larger risks. So if your position size is too large, a small market movement can quickly become a large drawdown. And that's why you must reduce your position size compared to even the previous years. You also need to pay attention to the macro data as well. Inflation at -2 to -3%, and the mixed GDP data. The market is still pretty much bullish, but the gold market rather is pretty much bullish, but it's not smooth. Okay, it's in what we would call a long-term bullish trend. So what I mean by a long-term bullish trend is over a long period of time, the overall direction of the market is still upward, but that doesn't mean that it's just going to be going up and up and up and up. You can begin to see sharp movements in both directions, but over the next couple of days, the market may rise strongly to the upside. And then you see the drawdowns, the corrections, which are becoming even very frequent in this market environment. But overall direction of gold is still pretty much bullish. All right. And then we have also the opportunities that the market has provided. But then more opportunities also mean more possible fake outs. Volatility is higher. The market is now producing a lot of trading opportunities, but there's also a downside, which is more fake outs. A fake out, if you don't know what a fake out is when price breaks a level, but then quickly reverses, right? I'll give you guys an example. We're going to look at it, right? Broke out of this level, and then you see that it quickly reversed back into that level. And that movement can trap traders that enter the markets quickly without confirmation. And just a quick tip, right? When you trade in volatile markets, if you use the moving average you can use the simple moving average instead of the exponential moving average. But generally, with the current market situation, guys, you need to be the trades in this period. In this period, instead of entering every setup that you see, just wait for clear confirmation, wait for proper confirmation, and apply proper risk management as well. Well, if we're going to summarize, the current market in one sentence, it will be that the market is offering more opportunities than before, but it's also punishing careless trading even much faster. What that means for you is that you must adapt. You can't be trading a high volatility market or a high volatile market. You can't be trading a high volatility market or a high volatile market with low discipline strategy. The traders that are going to succeed in this environment, this gold trading environment right now in this period, are the traders that, excuse me guys, are the traders that wait for their clear setups, stay patient, reduce the risk, and focus on consistency rather than quick profits. Let me know in the chat if you guys are following. Let me see if you guys have questions in the chat. Okay, everybody's following. Perfect. Now, let's talk about something can traders use in this environment. I'm going to share two simple strategies that even beginner traders can understand and practice. So we have the London and the New York breakout strategy. This is one of the most popular approaches in intraday trading. The session breakout strategy, right? So this is mainly focused on the two most active trading sessions. We have the London session and the New York session. Both of them usually bring the highest trading volume, and the idea or the objective is very simple. You identify the high and the low that is formed during the London session. If price breaks below the low, you consider it a sell opportunity. The idea is simple. Identify the high and low that is formed during the London session. If price breaks below the high, you consider a buy opportunity. If price breaks below the low, you consider a sell opportunity. So above the high rather, and then below the low. Above the high for a buy opportunity, below the low for a sell opportunity. Let me know in the chat if you guys got that. Let me know in the chat if you guys got that. And then we have filtered news trading. This strategy, obviously, if you guys watch my live trading sessions on the Octa Broker YouTube channel, you'll see that before I even go to the charts, I like to check the news. This strategy is focused on major economic news events, but you must do it carefully. So instead of just entering immediately after the news release, just wait for 5-10 minutes, because around this time, the market is going to be producing a lot of noise. So after the initial volatility has settled, you can now trade the breakout of the new range that forms. Excuse me, guys. And this works very well with NFP, CPI, for inflation, and FOMC. So follow the level breakout after the initial 5-10 minutes noise and manage risk. Okay, reduce your position size by 50% compared to the last 2 years. Again, asset prices are very much volatile right now. But guys, if you have any questions at any point in time, let me know in the chat, because when I don't see questions, I just assume that the classes are the session is very, I said classes, the session is very comprehensive. So here's something that a lot of beginner traders forget, right? You're not forced to trade gold. There are other, markets that are even calmer and easier to manage. You have pairs like Euro USD rather, GBP USD, USD JPY. These pairs move around 40 to 70 pips per day, and it's much more calmer compared to gold. The closest currency pair in terms of volatility to gold is GBP JPY. So if you need the same volatility from gold, you can still get it in GBP JPY, right? The same fast-paced, But for something calmer, you're looking at Euro USD, USD JPY, and GBP USD. You can also look at some pairs, some indices like the S&P 500, or even digital markets like BTC USD, ETH USD. These pairs are cheaper to trade, than some traditional assets, and you can even trade them during the weekends or during low volatility periods. So the key is to choose, markets that fit your risk tolerance and your strategy. Remember, the approach or the intraday approach for these assets is to reduce your risk and focus on range scalping and side stops, and look at the London and New York session opens. You can also look at the overlapping session from London that overlaps into the New York session as well. Pretty much, markets are pretty much active during that time. But let me know in the chat if you guys are following. Now, here are some risk management rules that you can apply to your trading. Guys, this video is going to be here on the Octa Broker YouTube channel. You can always come back and watch it. Learn, relearn, adjust, readjust. In case you miss anything, right? Get an adequate knowledge of the market and its risks before trading live. You want to understand market structure, the trading risk before you go live. Backtest new strategies on your demo account. You come on the Octa Broker YouTube channel, you learn new things. Backtest on your demo account before you go to your real account. Understand the impact of leverage. You see different leverage options on your Octa Trader account, and you just go ahead and choose anyone without knowing what it means. So understand the impact of leverage. Work on your risk appetite. My risk appetite may not be the same as yours. I could fund an account with $1,000, $2,000 just to play around with it and just see. But someone else may not be able to do that. Someone else may even have a higher risk tolerance than I have, right? Work on your risk appetite. And it also applies to your position sizing as well. Use a moderate position size. Set preferred stop losses and take profit levels on your trades. Choose a moderate risk to reward ratio. Guys, don't go about choosing 5% risk to 1% reward, guys. Come on now. And don't go ahead choosing 1% risk to 200% reward, guys. You don't move the market, okay? Something moderate. 1 to 2, 1 to 3, 1 to 4. Even 1 to 1 is good as well, at the very least, right? Nothing less than 1 to 1. Use a trailing stop on your trades to protect your profits. If you don't know what a trailing stop is, it's basically a stop loss that goes as your profit goes, so that you can, so in case the market reverses, you've already covered a certain amount of profits. Control your emotions. Do not overtrade or revenge trade. Know when to stop after consecutive profits. Don't start to feel like you're the magician of the market or the king of the market when you have a winning streak, let's say in a week, and then the next week you're saying, okay, I made profit all last week, I'm going to go higher this week and use 100 lot size because now I know how the market works. Guys, or even in a day, know when to stop, know when to sort of feel good for your wins and celebrate your wins and prepare for the next. All right, and know how to do it. Okay, don't get too excited, don't get too, risk, never risk more than you can afford to lose. 2% or less per trade, right? Don't go ahead, risking 50% on a trade. If the market goes against you, give me a second, guys. I don't know if you guys can still hear me. Guys, let me know in the chat if you guys can still hear me. Yes. Okay, I think it's good. I think it's pretty good. Okay, so how can we tell? Okay, we're gonna get to the Q&A. Okay, just keep the questions coming. Okay, keep the questions coming. We're gonna get to the Q&A session section of today's session, and I would answer all the questions. But quick one, homework, guys. Backtest one strategy over 20 trades on the demo account. If it's the zone trading strategy you want to backtest, fine. But backtest one strategy over 20 trades on a demo account. And if you check the description of the webinar of this video, you would see a trading journal, right? You can check the description of this video. You can utilize the trading journal for 5 different assets. I think you can also tweak that to add more if you trade more than 5 assets, but there'll be a template, a trading journal template that you can find in the webinar description below. So that's also an additional bonus for you guys as well. Now, if you made it up onto those points, congratulations. You have now unlocked the promo code that doubles your deposit in 5 easy steps. So you can use Gold 2026. That's the promo code to get 100% bonus on your deposit. Open the Octa Trading app or visit the official website. Go to your profile. Find the promo code section in the menu. Enter the promo code and click on activate. You can press it. Activate, you can make a deposit and enjoy your bonus. Remember, the promo code is Gold 2026. So when you're typing in the promo code and activating the bonus, you'd see a certain volume that you need to trade to be able to withdraw your profit to your bank accounts or to your trading account and to trade more and make more profit. All right, so now guys, we've come to the question and answer session. I'm here and happy to take your questions. So if you've got questions for me, please go ahead and let me know in the chat. If you have questions for me, guys, please let me know in the chat. I'm ready to answer all your questions. How can we tell the high impact news filter? Okay, how can we tell the high impact news and filter what's not important or needed? I got you. So the way you want to do that is to go to the Octa official website and go to analysis and education, and under that you want to come down to analytics and click on economic calendar, right? So you click on economic calendar, it loads up and you see all the events we have for the day. To filter, I mean, every event is needed, right? Some for the knowledge, some for volatile trading, but to filter and focus on only high impact events, you want to come down here to advanced filters, uncheck these 2 boxes, leave it at high impact events and click on apply filters. And now you're only going to be focused on high impact events. All right. So your economic events would now be focused on high impact. And it goes on for, even if you want to look at the events for the month, right, it's only going to be high impact events that will be showing for the month. Filter has been set and it's just going to remain like that. All right. How can one know a fake breakout? Good question. Good question. Now, it's simpler for me because I'm a zone trader, right? I don't trade when the market gets in the zone. I react to what the market does in the zone. So if this was an all-time high for me, I would actually wait to see the market either close above it to buy, just like the market created all-time highs here, went above but did not close. It pushed back down. Now that's not a confirmation for me. All right. So if you want to identify a fake breakout, you have to be patient enough to see if the market is going to close above or below your zones. If it doesn't close, that's a fake out. Any other questions, guys? Any other question, guys? Questions. So guys, remember, choose a strategy, backtest a strategy on at least 20 trades using a demo account. Start keeping a trading journal, write down your entries, your exits, and what you learn from each trade. Guys, you have to understand that trading improvement comes from reviewing your own behavior in the markets. All right, guys, we value your feedback. Please take 1 minute to fill out the survey. Your feedback helps us improve our future webinars. You can scan the QR code on your screen, or you can use the link in the description to give us your feedback. Let me check the live chat one more time to see if we have any questions. No questions. All right, guys, thank you all for joining this session today. I hope that this session helped you, understand better the volatility with gold and how you as a trader can adapt to the changing market environment. If you have any other questions, you can still ask in the comments, and we'll try to answer that, or we'll do well to answer your questions in the comments. Thank you guys again for joining. I'll see you next time. Bye, everyone.